about how loans really work. And today we got some special information on student loans and maybe a little bit more going on for you today. So I want to thank you for joining us. The P.I.L.L method is the cure for the common debt and the prescription for building uncommon wealth. So I want to welcome you one more time. This is episode 3, and we're going to be going over some things here. But first of all, let's start here on some things that are going to be coming up in the very near future. Let me put this up on the screen for you here. And there we are. And let me go ahead and share this on the screen. All right, there we go. There we are. You should be seeing that now. So if you're local to the Huntsville area, you're going to want to be here for this. This is Thursday, December 12th at 11 a.m. Central Time. That's when we're going to be doing ribbon cutting for P.I.L.L Method International at our offices right here at 103 Spinrin Drive, Madison, Alabama 35758. So you are invited. Bring your P.I.L.L Method book, and we're also going to be doing a book signing. You can get the book at Amazon for $14.99. We will have books available for $20 at the door. But go ahead, pick up your book early, get it read, and that way you'll be able to get it from Amazon. And also give us a review on that. So we'd love to hear what you're thinking about the book. Go to our Facebook page also, and you can make comments about the book, things that you're learning, things that you can share with others. We want to thank you so much for getting the book and doing that for us. So next, let's see. The book is going quite well on Amazon. People are learning quite a bit. So make sure, if you haven't received your book already, make sure you go to Amazon to pick up your book. Let me go ahead and share this with you and do a new share, and we'll put that on the screen. Okay, so go ahead and pick up your book at Amazon. You can get it for, like I said, $14.99. But if you get the paperback at $14.99, you will also be able to get the Kindle at a special price for $2.99. So you definitely want to do that. If you love reading your books on Kindle, get the paperback, get it on Kindle, and then you can share it, and you can give it away, and it's going to these books are going to make great Christmas gifts. If you're looking for a great finance book for your church, this is it. You can order them in bulk as well. Just contact us at info@thepillmethod.com, and we'll be able to supply your needs in bulk. Great Christmas gifts, great for churches, great for businesses. If you have a real estate business and you want to be able to share this information with your clients, you would be able to show them, with our help, of course, how your clients will be able to eliminate not just that mortgage you put them in, but their mortgage, their student loans, their car loans, personal loans, and credit cards in an average of 7 to 9 years. And if you're a real estate agent or broker, you would love to have this information for your clients. Give them the book. You can order them in bulk, give them the book, and let them know that they can be out of debt in a short period of time without changing their budget, cutting their interest costs by about 75%. So, folks, we're going to go ahead and get started on this thing. I'm going to go ahead and put a PowerPoint on, we're going to be talking about, starting out talking about, like I promised, student loans. Student loan debt is crushing. I mean, it's in the news. It is big time. That I've met people with student loans that rival mortgages. They have a student loans as big as mortgages and a mortgage. Some people are, because of their student loans, are delaying starting their families because of student loans. And some people are delaying whether they can, are even wondering if they can get into a house because of the student loans. So let's show you how we can eliminate student loans in an average of 5 to 7 years. Yes, that's what I said. All your student loans can be gone in an average of 5 to 7 years once we understand what's going on. So let me go ahead, put my glasses on here so I can see, and we're going to put the PowerPoint on the screen, and we'll get started. So let's go ahead and do that. All right, and do a new share. All right. And you all should be able to see that. Let me go over here, see if I can pull this up. And I'm looking at another screen just so that if anybody has any comments, I'll be able to see them. I can't see them on this screen with the PowerPoint. So let me go ahead and see if we can get this on here so that I can see any comments that you may have. All right, there we go. All right. See if we can find Finance Fridays here. There it is. Okay. So listen, folks, if you got any comments, go ahead and put them up. And I am seeing that you can see the PowerPoint now. Great. All right. So we're going to call this student loan larceny. Student loan larceny. And then let's go ahead and get into this. Now, not too long ago, I met a young man who had a student loan debt of only $9,500. $9,500. So let me put this over here so I can keep track of the time. All right, there we go. All right, $9,500, and his interest rate was 6%, and he had a monthly payment of $50. So I'm going to ask you, how long do you think it should take a person to pay off $9,500, not $95,000, $9,500 at 6% with a monthly payment of $50? So while I'm getting things going over here, you guys can do a little calculation and see if you can come up with something. And then if you get something, go ahead and post it. So let's see what we've got here. Let me do this. And there we go. And there. Now we've got that all set. All right. So $9,500 at 6% at 50. Are your guesses in? Let me go over here and see if we have any guesses. All right. Nothing yet. Okay. So what we have here is the answer is, skip the screen. All right. $9,500 at 6% should be 601 months. 601 months. How many years is that? That's 50 years, folks. $9,500 at $50 a month for 6 years is, I'm sorry, at 6% is 601 months or 50 years. How about that? Would you ever imagine that? Huh? So what are we going to do about that? What happens when this happens? So let's go ahead and continue. So with that, the total interest paid on this loan, the student loan company wants $20,550 interest on a $9,500 loan. Wow. It's crazy. That's a total paid back of $30,050. So if you take the interest cost as a percentage of the principal borrowed, okay? So what percentage is $20,550 of $9,500? It is exactly 216.316%. Oh my goodness. How in the world does the student loan company turn 6% into 216.316%? Isn't that crazy? So let's take a look at this thing a little closer, all right? So what we have here is what's called an income-based payment. So it's not designed to pay the loan off quickly. It's designed so that you can continue to make a payment, not go into default, but it's going to cost a lot of money in interest. So here's what happens when we have an income-based payment. So when we amortize a loan, that tells us how many payments, that tells us how many, what's the interest rate? The interest rate tells us how many payments and how long it's going to take us to pay that, and what our monthly payment is going to be, and what is the total interest cost. Now, when we do an income-based payment, the only thing that changes is the payment itself. The payment, the structure of the loan doesn't change. We just change the payment. So what we're doing is just reducing the amount that goes to principal, but the term remains the same, the interest rate remains the same. The only thing that doesn't change, the only thing that changes is the amount that's going to principal. Now, here's what happens. This is what happened to this person here, that his payment became so low that just a little bit of money goes to principal, which takes it a very long time to pay off. And we're going to get into that amortization schedule in just a moment. But first of all, we're going to go over what income-based payments mean. So I hope you get that. We're not restructuring the loan. Okay, when you restructure the loan, you may get a new interest rate, you may get a new amortization, you may get redo the loan and say, okay, we're going to at least do something reasonable for you. All we're doing is changing the amount of the payment. It is not restructured in any other way. So there is another thing that's going on here when we restructure, when we do a income-based payment. And that is, some of these loans become negatively amortized. You want to write this down. Some of these loans become negatively amortized. So what does that mean? So if they're negatively amortized, that means that no money is going to principal at all. And it's even worse. Now, what I just described was an interest-only loan where the individual is just paying interest and nothing goes to principal. Now, that's bad enough. But a negatively amortized loan means that even the amount of interest that you were supposed to pay that month, you're not covering all of the interest. So let's say your interest payment was supposed to be $100. And after you pay the interest, then money can go to principal. Okay, so if your um, uh, interest payment is $100, but when you receive your income-based payment from the student loan company, your student loan payment could be $90. Yeah, you could have a payment that's less than the interest that is actually being charged. So what happens if you have a $100 interest bill, but your payment is $90? What happens to that $10? That $10 becomes part of the new principal. So that money that you were supposed to pay in interest that you did not pay becomes, now here's a new word for you. It's called capitalization. So they capitalize that unpaid interest and it becomes part of the loan. So not only are you not paying anything on principal, now if you have an interest only loan, the principal remains the same. You're just paying the interest, the principal remains the same. So if you owe $50,000 and you're just paying the interest, 10 years from now, you still owe $50,000. Okay? But when you have a negatively amortized loan, if you start out today with a $50,000 student loan, 10 years from now, you'll owe a lot more, because not only will the unpaid interest become part of the loan itself, you start to pay interest on that interest. That's what capitalization is all about. There are so many student loans out there that are like this. Do you know, I meet people all the time that are just a few years away from retirement, and their student loans are still with them, and they owe way more now than they did when they graduated college 10, 20, some even 30 years ago. Yes. How in the world does this happen? Now, is there a way to pay back a negatively amortized loan? Yes, there is, once you know how. And we're going to get into some of that a little bit today on how to handle these loans. So folks, so we picked up some valuable terms today. We picked up a income-based payment. And then we went over what it means to have an interest-only payment. We went over what it means to have a negatively amortized loan when you're not covering even all the interest, so that the unpaid interest becomes part of your loan and you start to pay interest on the interest. That's capitalization. Did you know that? Let me look over here, see if there are any comments yet. No, not yet. All right, but we do have some people coming on. Now, you want to share this. When you see this, you want to share this with all your family and friends. Once we're through with this episode, number 3, we're actually going to upload this to YouTube, and that will become on our YouTube channel, the P.I.L.L Method YouTube channel, and that way it's going to be there forever. So it's part of the Finance Friday show, and I want you guys to know that I enjoy doing these shows. So, but let's go ahead and keep on going. So here is how this loan breaks down. Remember, I told you that the payment is $50. So look at this payment number 1. Look at how much goes to principal. $2.50 goes to principal, while $47.50 goes to interest. Isn't that crazy? $2.50 goes to principal, $47.50 goes to interest. So remember, our payment, we had a $9,500 loan. So what we're doing is we're subtracting the $2.50 from the $9,500. And when we do that, we end up with a balance of $9,497.50. So the bank takes that the principal balance and then does a multiplication, and then we figure out how much interest we owe on line number 2. So the balance on line 1 determines what we pay in interest on line 2. Now, because we owe less than $9,500, obviously we have to pay less interest on line 2. So let's take a look at line 2. Month number 2, $2.51 goes to principal, and the interest cost goes all the way down to $47.49. What? It was $47.50 on line 1. It's $47.49 in interest on line 2. It only changed by 1 penny. Look at that. So that's why it takes 50 years to pay this thing off. We're just paying just a little bit of money on principal, and the interest cost is going down just by a penny or two every single month. Look at that. So how do we combat this? So remember, if you remember from my other videos, you want to focus on the principal amounts. So if you have, and this is why I tell people, if you have a very small principal payment or if you have a large interest rate, then there's a way to beat this thing so that you can come out on top. All right, so let's take a look at it and see what we could do here. All right, so what we're going to do is take a look at line 12 on our amortization schedule. So that's month 12. After 12 months, we're going to take a look at column number 3 and see that we would actually only pay this loan down by $30.84. That is all of the principal payments added up for 1 year. $30.84. Do you see that? Okay. So what if we decided we wanted to prepay $30.84? What if we decided we wanted to make a payment and then give the bank an extra $30.84 in just 1 month? Not over 12 months, but we wanted to give the bank $30.84 in 1 month. What would happen? All of the interest payments between line 2 and line 12 are in this red rectangle. What happens to them? You got it. You do not have to pay them. That's a savings of $569.16 minus the $47.50 on line 1. So what happens? If we give the bank $30.84 at one time instead of $2.50 a month. So here's what we're saying. Once you make that $50 payment, anything else you give to the bank goes straight to principal. Make your $50 payment, go search through your couch cushions, come up with $5 or $10 or even right here, $30.84 and put it with that regular payment. And folks, look what happens. You're paid all the way down to line 12 in just 1 month. Now, I bet when you were looking at this, they said, how will we ever get out of this thing? Because with $2 going to principal, we're going to be in this thing forever. But I want you to know that when you see a small principal payment, you should start rejoicing. You should get a big old smile on your face because you're going to be able to do some fantastic things with these loans and save a ton of interest. Look at that. So what would happen if we were to do line 25? Look at this, $66.39. $66.39. So after 25 payments, after 2 years and 1 month, doing it the bank's way, this loan would only be paid down by $66.39. And how much interest will we pay? $1,183.61. It would cost $1,183 just to give the bank $66.39 if we do it their way. But what if we decided we didn't want to do it their way? You know, we make a payment and give them an extra $66.39. So if we had a $9,500 student loan and we give the bank $66.39, they have to subtract it from what we owe. If they do that, look here. Subtract $66.39 all at one time, you're left with $9,433.61. Folks, that's the same thing that's here on line 25. What? Get out of here. We could do this instead of giving it to them at $2.82 out of a $50 payment for 25 months. You better believe it. You better know that this is how it works. And you could save a ton of interest by doing this. I'm telling you, this is fantastic. So listen, folks, we're going to pause for just a second for a little contact information. If you want to get my free information app, it's a free information app. You can learn a little bit more about the P.I.L. method. You can research us. There's some information on commercials that we've done. There's information on news articles that are there. As our website address is there. All you have to do is text TPM to 36260. Text TPM to 36260, or you can call our office number at 256-886-1867. Or you can email me, but there's our website address as well. If you would like to get a free savings report, meaning if you have student loans, mortgage, car loans, credit cards, if you would like to know the month and year you could be debt free, and usually it's within a 7 to 9 year window. That is the average. Some are a little less, some are a little more. It all depends on how much money we have to work with. But our computers, our opportunity cost calculator, our artificial intelligence, as it were, will guide you to zero debt by showing you how to cancel all of that interest so you don't have to pay it. So you can go ahead and text TPM to 36260 and start receiving some of our information about the P.I.L. method and how we are helping people, not just in this country, but in 9 other countries as well. So get some free information. Text TPM to 36260 or go to our website, get some more information. Okay, back to the presentation. So did you get anything out of that about the student loans? Did you see what's going on with this in the student loan industry? Before we talk about this next subject, I want you to know that the reason why it's so easy to get student loans, you see, when you get other loans, you have to jump through a lot of hoops. You have to qualify. You have to have great credit score. You want to have to show that you have some history in paying your bills. But why is it so easy to get thousands upon thousands of dollars in student loans without jumping through all of those hoops? The reason is because most of them are backed by the government. They're government student loans that are, but we have private companies that's issuing the money. This is why private companies fight so hard to get into your a higher ed institution, to the point where these student loan companies are donating monies, they're building buildings, they're doing a lot so that they can be on the preferred list of your financial institution. How about that? I'm telling you, if they can get on your the preferred list of your financial institution, and then these loans that the students receive, they are guaranteed by the government. Here's what's happening. So you would wonder, why would a student loan company give you a payment where you could never, ever pay the loan off, an interest-only payment, or a negatively amortized payment where your loan is actually getting larger every single month? Why would a company whose job it is to lend money and make money that they'll never get that money back, why would they do that? Because they have already received their money. Remember, these are government loans. They're guaranteed. The student loan companies have already received their money. Any extra money they get from you is just icing on the cake. When we get these student loans, we need to really understand what's going on with them. Now, here's what here's what I believe right now. I like the idea of student loans. The reason why I like the idea of student loans is because we can borrow somebody else's money at wholesale. We don't have to pay retail prices for these loans. They can be paid off in 5 to 7 years. You saw what can happen with just a small amount of money. We could have knocked off 2 years off that loan with just $66. If people knew that, they would be out of these loans in 5 to 7 years, cutting their interest costs by 2/3 or more. It is amazing once you know what to do. So what's going on with these guys? So what's happening is they're working very hard to get you to sign up for these loans, not knowing what's going on. And then the government pays the student loans companies because the loans are guaranteed, but you've signed a contract that says that you owe the money that you must pay. So as long as they can keep you paying and paying and paying, they're going to be okay, because they're going to keep getting money on top of the money that they've already received from the government. How about that? I mean, that sounds like a pretty sweet deal for the student loan companies. Let me give you a little advice. For those of you who have the resources, I'm going to put a little bug in your ear, because this is an idea that I gave to one of my doctor friends who was about to write a check for their college age student. They were a freshman, a freshman at Oakwood University. And I said, listen, and they were getting ready to write a check for that semester's tuition. And I said, oh, you're writing a check for the tuition? They said, well, yes. I said, well, have you considered student loans? I said, well, why would I get a student loan where I can easily write a check for the tuition? I said, well, let me ask a couple of questions. When do you have to start paying a student loan? I said, well, after my child graduates. I says, well, on most of these loans, when do you have to start paying interest on these loans? After the child graduates. I said, well, why don't you get the student loan? Then that money you're about to pay for the tuition, why don't you put that in a safe investment for the next 4 years? So all that tuition money goes into a safe investment where your principal is guaranteed. If you want to know what some of those safe investments are, you definitely want to contact us at the P.I.L.L method, because we have that information for you, where you can put your money into an investment that is guaranteed, and even if the stock market does a downturn, you don't lose any principal at all. All right? So we put that money in there for the next 4 years. Just put that tuition money in there. And then when your child graduates, take the money out of the investment, pay off the student loans in one lump sum, and keep the change. That sound like a deal? You better know it. See, this whole idea, folks, of working with money is looking at all sides of it. It's called opportunity cost. It's opportunity cost lost, opportunity cost gain. Whatever decisions you make about money, you want to know what it's going to cost you or make for you long term. So here's another situation. This one is called Refi Fantasy. All right. And so we've got a few more minutes. Let's talk about why banks refi. Do you know that Americans don't have 30-year mortgages? No. Most Americans have a string of 5 to 7 year mortgages until they die. Because every 5 to 7 years, we refi our loans for one reason or another. But let me give you a common scenario. Okay, John and Rebecca Jones. They decide that they meet in college. They decide they want to get married, and they go ahead and after their senior year, after they graduate, they go ahead and get married. And so they have their student loans. They've got a couple of cars. They got very good jobs, so they're okay. They've got a mortgage, so they're doing their thing. So now, once they are established, then what if they decide we'll go out and get a very nice starter home, and they do that. So they get a nice starter home, and then John and Rebecca Jones, well, they want to start a family. So, so a few years in, they have their first child. Now, when they are about to have their second child, they start to realize that the house that they're in 3, 4, 5 years later is getting too small. We have to go ahead and get another house. So 5 to 7 years in, now they have a 30-year mortgage. They're 5 to 7 years in already. So they go ahead and get another mortgage for a larger home because their family is growing. All right, great, fantastic. So let's say they're 5 years in and they get a brand new 30-year mortgage. So even if they paid it off on time, they'll have a mortgage for 35 years. So here's what's happening. So now their family is getting established. They're making a little bit more money, and let's see here, 5 to 7 years in, guess what? After they have this new mortgage, 5 to 7 years in, their phone starts to ring off the hook, and their mailbox gets stuffed full of offers to refi their loan because the interest rates dropped by 2 points, and now, bam, they get hit. And they said, well, we're at this interest rate. We can drop it down 2 points. That's got to be better than what we're doing now. So they go ahead and they refi. They may even cash out to pay off some of the student loans or maybe some of the credit card debt. I mean, it's common, but they were 5 years in, and now they're another 7 years in. That's what, a total of 12 years in. And then they refinance to another 30-year mortgage because they could get a better interest rate. So now the kids are growing up. You're about 7 years in, so the kids are growing up with a new family, and now 5 to 7 years later, another 7 years. All right, so they've got 12 years in, and now with another 7 years, they're 19 years in. Okay, and on the way there, they realize they haven't put away as much money as they wanted to put away for little Johnny's education. So what do? They go ahead and refi so they can cash out to pay some educational costs. They're 19 years in, and we get a brand new 30-year mortgage after 19 years. So if you add on the 19 to the 30, they can't get out for a total of 49 years now. Okay, so now, after another 4 or 5 years, and we're working on getting everybody through college, and now we're another 7 years in, getting everybody through college, and hopefully through college and gone. All right, out of the house. Mom and dad are happy. You know, we got the house back to ourselves. We got maybe they have a prospect of some grandchildren coming along the way. I don't know, but the kids are out of the house. So they were at 19 years, and now there's another 5 to 7 years. So now they're 26 years in, and guess what? The kids are gone. Mom and dad are kicking around this big old house all by themselves. So what do? You guessed it. They downsize and get a brand new 30-year mortgage. At this point, they are like 55, 60 with another 30-year loan. That's how it works. So, folks, let me ask you something. If you thought most people refi to save money and to pay off their loans faster, that couldn't be further from the truth. So let me ask you something. Why would your bank, the one that has you in the so-called higher interest loan, when the rates drop, why would your bank contact you to try to save you money? Because here's the question you need to ask. If I'm saving money, then who would have to be losing it? If I'm saving money, who would have to be losing it? I know. You can't even say it, can you? The bank would have to be losing money, and they're calling me so that they can lose money? No, folks. When there's a refi going on, they make money several different ways. Let me show you what's going on here with this thing. Let's say you had an opportunity, you have a $200,000 mortgage at 6%, and the bank is offering to refinance that thing at 3%. We're going to roll in the closing costs. Should we take it? So so we've got to take a look at all the math in this thing. Sometimes it's good to refinance, and sometimes it isn't. How do I know when it's time to refinance? I don't know. All I know is if we do the math and we figure out we're either better off or worse off in how much it's going to cost us to manage our debt before we refi or not. Before we're either better off not refining or we're better off doing a refinance because it's going to accomplish some goals for us. So if our goals are accomplished, if it's going to cost us less money overall, then go ahead, refi. But if you don't know, don't touch that thing with a 10-foot pole until you know what is going to be the end result. How are you going to be better off in the long run? You have to do the math. So we got $200,000 principal, 6%, 30 years, monthly payment, $11.99.10. Okay. So, what if these folks, John and Rebecca Jones, want to refinance this mortgage after 7 years? Let's see what happens. So, with the first year, okay, the first year we have, let's see, after 11 months. Nope. After 12 months, here we go. We will pay this loan down by $2,456 and a penny. But how much interest have they paid in just 1 year? That's $11,933.19. So after 2 years, we've already paid $23,714.90 in interest. We're looking at column number 4 over here. That's cumulative principal, okay? Cumulative principal. Hold on. I do a lot of talking and throat gets dry. I gotta keep the whistle wet. Okay, so we have $5,000 in principal paid, but it's going to cost us $23,714.90. So, folks, here's another way to look at this. $5,000 in equity, but it costs $23,000 to get it. That's a total of $28,000 paid out for a $5,000 benefit. Do you see why we want to attack these loans at the point of where the problem really is? The interest cost, not the principal over here. We want to start managing this interest cost so that we can give the bank back their money at a much lower interest cost. That's what we want to be. That's how we want to do this thing. So after 7 years, that's 84 payments. John and Rebecca Jones have paid down their principal by $20,721.13, but it cost them $80,000 in interest. You know what? You know what I think? I think everybody who refinances should first figure out how much interest they've paid in the 5 to 7 years they've been in the loan before they refinance that thing. They would be shocked to see how much interest they would save, and then look at how much more interest they're going to pay on top because they refinance. Look at that, $20,700 in principal. That's $100,000 paid out in just 7 years. Their total loan was $200,000. They've already given the bank back half of what they borrowed, and they still owe $179,000. They've already paid $100,000. That's half of what they borrowed, and they still owe $179,278.87. This is what's happening, folks. This is happening all the time. And there are legislators right now that want to legislate payday loans when this is going on every day with mortgages. How about that? Okay. So let's take a look at this. So we have $179,000 that we owe, $179,278.87. Now, of course, when we refinance, there's going to be a closing fee, but don't worry about it. You don't have to come up with a closing fee out of your pocket. You're just going to roll that in. So you don't get a 3% interest rate without having perfect credit. Okay. So, I mean, you've got to have it. You've got to be on the ball to get a very low interest rate like that. So now, we're going to get so we owe $179,278.87. We owe We have $5,000 in closing. And so now our total um, uh, principal borrowed is going to be $184,278.87 at 3% for 30 years. Our new payment, oh boy, we're smiling now. Our brand new payment is $776.93. So here is the breakdown. So we borrow $184,000. Our new payment is $776 at 3%. The interest paid on that amount is still going to be $95,415.93. That's a total repayment of $279,694.40, not to mention the $100,000 we've already paid out. Okay, we always forget about that. And $80,000 of that was interest already. So what is our total our total interest paid as a percentage of principal? 51.778%. Folks, even at 3%, we're going to pay back 50% of what we borrowed. 51.778%. How in the world does 3% become 51.778%? You know what? That's probably the subject of next week. We're going to talk about next week how, let me make a note of that, okay? So next week, let's figure out how these loans get so expensive. So let me put my note down here. Hold on. So we're going to figure out how the bank does that amortization. Figure out how to charge interest. So how they charge interest. So we bring your calculators next week for episode 4. You're going to need it. So how does the bank charge interest? Episode 4. Okay. There we go. Number 4. All right. So we're going to go over that. Bring your calculators. We're going to go over that a little bit. Plus, we're going to go over, since we have the calculators, we might as well make good use of them, right? And you can use the calculator on your phone even. So let's see. We're going to go over not just that, but the idea of diminished return. There's a point at which you can pay too much on a loan and hurt yourself. There's a point at which more becomes too much. It's called the law of diminished return. And we're going to go over that a little bit next week. So bring your calculators next week. Now, don't forget, tell everybody, be here. Listen, click share. If you're in the thing right now, go ahead and click share. We got 3 comments on here already. All right. So we got Curtis Bryant in here. Thank you very much, Curtis. RL Chance says, wow. Jamal says, he's shouting out. That's great. So listen, folks, go ahead and share this information with everybody. Just hit share, get it out there. All right. Let folks know that that Finance Fridays is here and it's here to stay. All right. So so next week we're going to be talking about not opportunity cost, but how does the bank charge interest? How does that work? How does 3% become 51%? How does 3% become 51%? And we're going to talk about the law of diminished return. So people say, well, Don, all you have to do is pay extra. No, it's a lot more than just paying extra. You have to be careful and move the right amount of money at the right time in the right month to the right loan so that you can save the maximum amount of interest that's mathematically possible for you and your family. That's what's important here. Okay? So next week, that's what we're talking about. Bring your calculators, hit share on this thing, get it out there. Tell everybody about it. All right, so here's what we have. We got a few more minutes left. So we have $11.99.10. Here is our new payment. So we're saving $422.10 $5,000.17 a month. Now, let's pay back the $5,000 in closing fees. All right, are you ready? So we're taking a look at column number 3 and column number 4. Remember, we rolled in $5,000 closing because we didn't want to pay it up front. So in 4 months on this brand new loan, we've already racked up, we've already paid back $1,269.68. That's, and then how much interest have we paid already? $1,800 on a $1,200 loan. After 7 months, we've paid back $2,230.31 of the $5,000 closing fee, and we've already paid $3,200 in interest on that. That's at 3%, folks. This is a 3% mortgage. In 10 months, we paid back $3,198.15. We still haven't paid back the fee in 10 months, and we've already paid $4,571.15 interest. And look here, in 13 months, we've been on this, listen, this is what I call being in your mortgage, not paying a dime on your mortgage for 13 months and still keep your house. How do you do that? Roll in the finance fee, because that's all you're paying back is the finance fee for 13 months. That's $4,173.27 in finance fees, okay? And how much interest did we pay already? $5,926.82. Come on. So it finally, we pay back in 16 months, we pay back $5,177.72 in principal. It takes $7,275 in interest to do that. That's a total of $12,430.88. Let me ask you folks, is there any way I could get you to borrow, to take out a $5,000 loan for 16 months and pay $7,275 interest to do it? There's no way I could get you to do that. But people who refinance do this every single day. If you know someone who's getting ready to refinance, please direct them to the P.I.L.L method right now. Get them to text TPM to 36260. Call us at 256-886-1867. Go on our website. Make sure that they get this information before they refinance. And then let us do an analysis for them so they can really see what's going on. And not only that, folks, but we're going to get out of this screen and we're going to put this screen up. All right. And we're going to do a new share and make sure that you're getting your copy of the P.I.L.L method book. Some of this information that we're going over here is in this book, and why you need what we have, why you need an opportunity cost calculator is in this book. Tell everybody that you know. It's going to make a great Christmas gift. Make sure that your people in your church get it, people in your families get it, people in your organizations get it. If you have a mortgage company or a real estate company, I guarantee you, you'll be able to help more people get more mortgages and more homes if they have this book and use our system, the P.I.L.L method, a better way to eliminate debt. Folks, that's my time. I want to thank you for joining us. I had such a great time going over this information, and I just want to be able to tell you, listen, folks, come back next week. Glad to work with you. And remember that the P.I.L.L method is the cure for the common debt. And we are the prescription for building uncommon wealth. See you again. See you till, be safe until next week. Talk to you later. Bye now.